Sorry. Look at that. Wow. Whoa. Keep it professional. Family show here. So good day to you, everybody. Today we're going to do some technical analysis and fundamental analysis. I'll try not to be a narcissist today. We will cover anything you want, in fact. So sometimes we just do blow through the technicals. Sometimes we spend an hour talking about fundamentals or trader psychology. Sometimes we do a little mixture of both. Sometimes we do, some sort of tactical training. How do I handle this situation or that situation? So really, you guys kind of dictate it. So be careful what you ask. I don't show up going, oh, I'm going to go on a 90-minute diatribe. But anyways, I'll do what I will do what I can to help. So thank you for being part of the Forex.Today YouTube community. More than 16,000 people. Honestly, I think that's really cool. It's not the biggest faux show. No, we don't get 10,000 people watching the videos live like Bitcoin Boy, but we have a small community. Maybe it actually helps me address what you need and what you're asking for. So it's big enough, it's small enough, it fits just right. So please ask questions, please get involved, please take notes, please document your thoughts on the training videos, that kind of thing. And what else? Thank you to Traders Way for being a supporter of our community, a broker we can rely on, fast execution, narrow spreads, wide swaps. They actually enter your trades in the interbanking system. If you have an ECN account, the fees are half price right now because of COVID. Okay. Raymond says, I want to see if the Moo trade still lives. Yeah. Not in this scenario. Okay. These are still not quite unique. These are still not quite normal markets, and they're still a little bit unique. They're still sort of, we're trying to all get on the clue train here. So, sorta. That's right. So on the 11th hour of the 11th day of the 11th month, the armistice for World War I was signed. And I've been on the exact spot where that happened. I can't quite remember where it was. France, I think. Might have been Versailles. But anyways, yeah, cool. So yeah, please let me know what pairs to cover today, and I will do my best. And like I said, I thought maybe I'll see if I can use these marker things to kind of organize things. Maybe it'll help me organize my thoughts as well. So thank you for being part of the community, and thank you to Traders Way for being with us. Okay. So I'm going through a decision-making process. Now, this is actually me experimenting, so don't look at what I'm doing now as sort of like the God's truth of you know what to be doing. I'm actually kind of testing on this account how much of past what would you say? Not performance, past. I'm testing my memory of the past versus reality now. And the markets have been changing over the last few years quite rapidly, actually, as it became more mature. And there's less gaps, there's less volatility, and of course, there also can be less follow through. And so I'm just kind of I'm playing it here a little bit. Okay, so to me, I think explaining the thought process and the concerns and stuff can be a learning experience, right? So the way I had this before, let me go back to the swing trading bullish. Okay, one of the things in my mind is if you, oh, where did that go? Oh, I see. I need my drawing tool. Okay. Okay. By the way, did I see Morena? Was she in the chat today? That's cool. I haven't seen her in a while. So one of the things I'm kind of testing here, remember scientific methodology, it's sort of this, okay? Yeah, right on. Ba-ba-ba-ba. Do you happen to know this guy? the guy that sent the email chain? This is just funny. So hurtful though. So angry. Um, so anyways, guys, so my thought process is this is next week. Do I hang for it? Or do I play it safe? So like we can contrast this with the conversation we had about Raymond taking profit up here. Not because of this. Well, sort of, I guess. You can take this to this to this. This is what I'm doing, XX. This is a testing process, right? So this is my coaching account. It's got, I don't know, 36,000 bucks in it or something. And so I got these trades on, and it always, this is always a question, by the way. Is that right, Marina? So, all right. So that's just, it's a cultural thing, huh? Yeah. Very. I don't like it though. So hurtful. Holy smokes. So anyways, so the testing thing. So we know, so what is it? So basically 1,000 pips is, on that is, let's say, we'll call it 1% is like, let's say 333. So 3% is 1,000 pips. Okay, so I was up closer to 5%, which is an okay month, right? All right, so the thing is, the test here is, was it really truly proper for me to have gotten out? Okay. We laugh at them. Yeah. It's all cultural too. So, you got to always remember that. My Indian friends are tough to negotiate. And so I must imagine in India, you negotiate all the time. I've been to India, been to a lot of cities in India. And yeah, I get it, right? So it's funny, one time I'm in Mexico and we're going through some small pittance of a little town. And, they're selling fake Cuban cigars and, leather purses and silver jewelry. And my Indian friend goes up and his wife likes something. So he's like, okay, I'll buy it. How much is it? And she's like, it's like $200. And he's like, I'll give you $40. And she's like, no, it's 200. He's like, gives her the $40. She's holding the $40. He takes it. And she's like, you can't do this. You're not paying me enough. And he's like, it's okay. It's okay. It's okay. And he's walking away. I'm like, dude. And he's like, no, it's okay. She's like, you can't, you owe me money. It's not enough money. He's like, no, it's okay. It's okay. She's holding the $40. He's got the jewelry, and she's yelling, screaming, but not chasing him, not calling the cops, not doing anything. He's like, no, it's okay. And he's just walking away. No, we're done. You got the money. It's all good. It's just funny. I'm like, holy smokes. By the way, that guy just went through an IPO and became filthy, stinking rich. Isn't that great? Good for him. Another friend that's just made it. But anyways, he's like, no, it's all right. It's okay. So, just, wow. But anyways, so we all get mad and all that. Okay. So the question is, again, see, I don't know at the time, so we have to test and I make, okay, great. On the short run, we know it's the right thing to do to take the 5%. Yeah, I kind of thought that, Marina, but yeah, I mean, yeah. Okay, so is this the right thing to do? Should I have taken the 5%? I don't know. Now, we do know technical analysis, of course. And the technicals told us on a different time frame now that in a normal market, which is like probably every time except in this situation, let's go to Confluence, it certainly was the right thing to do. In those markets, in normal market conditions, in those prices, this is an obvious up, this is an obvious up, this is an obvious exit. Gotcha. So in, let's say 99% of the time, that's the right thing to do. So now it's like, how about this? Are these market conditions post-election unique enough for me to override my normal rules of engagement? Okay, so I think Raymond did the right thing in these situations where he took off probably more than 5%, right? And as a portfolio manager, that's actually what we're trying to do. Consistency over, anything else. Okay? And I've explained this to you, I've given examples, so many examples over this year trying to show you that it's okay to have low volatility and medium returns, or even low volatility and consistently low returns is actually very attractive. Okay? So in this situation, if you have the beta, which we know we have the beta, then you can have outperformance this month. So the question is, now, with all that, and that is the right thing to do, so I'm not judging anything about that. I'm judging it and I'm saying it was the right thing. And remember, I gave warnings like you got to make decisions. You got to have contracts. And I told you down here, have a contract with yourself. What are you going to do? Okay. So now we get in this scenario. What if this is the right thing, let's say this week, this month? The question now is, will these markets perform as they have in years past? That's what I mean by the testing here. I don't mean like back testing and stuff and doing simulators. I mean, like, how about this? Let's try to answer it this way. And this is just, I'm looking at Euro. It's just a random, it's not even probably the right thing to be using, but let's just change the template to simple. Oh, I got to get rid of these volley bands. All right. And then let's go to back in time. I'll probably have to go weekly. Okay. Okay. Here's the election 2016. Okay. Right here. So this is where we are right now. So I'm trying to say, are we in this candle right now? And should we be freaking out? Or you could say, no, Wayne, we're in more like one of these candles. Well, that's late November. So we're like in this period now, honestly, right? So let's move one click forward. That's the 13th. Today's the 11th. So we're literally inside that gray right now. And let's see if I can see. I hate MT4 for this, or when you zoom in, it's hard to catch. Boy, Dealbook 360 was great for that. You could just look at it and zoom right in on exactly what you needed. Okay, so it's going the other way. Just trying to zoom in here. And so what I'm saying now is I'm not looking at opinion here. I'm trying to say, well, what has happened in the past and how should I handle it? So this is actually, this is election week. You can see it's like a giant spinning top. Then it was bullish the week after and all that kind of stuff. So we had a big week the week after the elections 4 years ago. Okay. So the question now is, should I take the money because of this move here? This was a nice, beautiful move. And we could say, oh, weekly pivots, which is the correct answer. And then you could say monthly pivots. We could say correct answer. That's correct. Nothing wrong. If you take profit, you're not going to go broke. And Raymond wasn't picking up pennies, right? He crushed it. He was taking trades with 300-400 pips each, right? Can't go broke doing that. So, but the question is, can I also hang on to this? Because that's another 500 pips, another 300 pips, another 300 pips, another 300 pips. Does this still exist in our world is what I'm testing. Not that it can be done, but does it still exist? In my mind, it does, because I've traded this many times before. Okay? So, but does it exist now? And what has changed, of course, is we've gone from about $4 trillion a day to $5 trillion a day. And because of the increase in market participants, we have less volume and volatility, which is like, it becomes more and more of an arbitrage game where there's still a lot of up, but there might be a lot more bears now in this situation. Okay. You know, Ian Raymond says, I'm just shocked how quick it moved, right? Well, isn't that interesting? Because we did talk about that way back in the day where I said, look, here's your risk, Raymond. Because, by the way, Raymond declared he was going to try to do what he did. Oh, we were talking about this early in the year, first quarter, February, March, April. We had multiple discussions with the group, one-on-one, all these different things. And I said, the risk is you do a whole bunch of trades between now and the election, and in particular, you're thinking they're going to start moving in August and September, and I don't think it's going to happen. It might, but there's a huge risk it won't. And I said, the real shame is then you temper your enthusiasm to the point where you kind of give up on it. And I said, this is a real risk. And then, boom, you missed it. You were, right? You just missed it. And then it's over. And you're like, you were waiting and waiting, gave up. Right? It's kind of like waiting for a bus. You've been there for hours and you're waiting. You know it's coming. And it doesn't show up. Then finally, like, I gotta pee. So you run into Starbucks, pee, and while you're peeing, the bus comes by and you miss the bus, right? So I'm like, dude, you gotta be careful. So stay with your plan big, expect small. How many people here remember talking about that over and over in the first half of the year? Plan big, expect small. Plan big, expect small. Plan big, expect small. Because I don't want the psychology of your confidence to wane. I want you to say, well, I had good shots, they just didn't follow through. Right? Yeah. Ready, willing, and able, then ka-chow. So, I mean, honestly, I think those are the biggest lessons. How to remain confident, how to remain patient, how to adjust your expectations so you don't give up. Because the worst thing is, right? And I remember we had this conversation with Constantine, right? Where he had a lot of big winners, but he didn't take profit on them, which, okay, fine. That's just part of the strategy. But I said, the worst thing though, Constantine, is that you think you're doing something wrong. You don't realize it's the market conditions are abnormal because this is the fourth year in an 8-year political cycle, right? Like, so in that situation, the markets do perform differently than normal. So it's not normal, but you're trading like it's normal and you're not getting expected results. But here's the thing. I mean, and his problem was he'd be up 200 pips and he'd break even. Up 200 pips, break even. Great entries, no follow through, right? So what I said to him, look, don't give up on the strategy. Just understand that the market conditions are different. Maybe you should be behaving different than you are, but it's not your trading strategy. It's sort of the risk management strategy. I said the worst thing is you give up on what you're doing right, because obviously he's doing a lot of things right if he can make 200 pips per trade over and over again. Right? It's a risk management thing. It's not an entry thing. So what if the worst case happened? He gives up on the strategy, changes his behavior to mimic what happened this year. And then next year we have a normal year. And now he's doing, again, the right thing in the wrong year. Instead, I said, just stay confident in what you're doing. It will work out by the end of the year. And of course, next year, you'll see much more expected results. Maybe not better results, but better in the sense that it will be easier to manage because it'll move more like what you're expecting, right? And that, like, how to trade across or how to trade price action, I think those are pretty easy. We can fix those. Some training, some meetings, some get-togethers. We can fix that. But getting the head screwed on straight, it took me a long time. Maybe I'm not even quite there yet, right? So, right? So now I guess what I'm saying is, on a weekly basis, should I bail because of this candle? Or is it going to end this week relatively high, and then next week be higher, and 2 weeks from now we're getting a higher high, or we're on our way to 130? Okay. So what happened here? Okay, we can see it opened low and closed high, but we can't see what happened in between. So for example, this opened low, went high, has come back down, but if by the end of the week it closes relatively high again, back on its way to 124, 124.50, 124.50 to 125, then it will close exactly the way it closed 4 years ago. You see? And I got out of a trade with only 125 pips. You're like, what the hell? How embarrassing, right? So that's why I'm sort of like, I'm trying to pay attention, okay? So this is my coaching account. I'm coaching you, but I'm coaching me in the sense of I'm testing reality to make sure I see it. Because do you think Forex trading will be exactly the same 10 years from now? I think it'll be relatively the same, but not exactly the same. And I don't mean like the central bank policy will be the same. I mean, what if we're doing 10 or 12 trillion a day? Will we have the same market behavior? Will market participants be the same? And what I've seen over 15 or so years of doing this, more than 15 years now, but over 15 years, I've seen volume go up and volatility go down. I've seen the loss of the carry trade. And by the way, remember I told you that they had a Forex guy come to my class and talk about his form of trading, because we were studying last week alternative investments. By the way, I didn't even study for the test, and I got a 90 on the exam. But anyways, he came out and told us about Forex trading, and then at the end, because I'm a narcissist, whatever, they asked for feedback, and I'm like, oh, this is pretty good. Some of the speakers, because we had quant guys, we had, there's a lot of different hedge fund, long, short, equity. We had pure hedge. We had arbitrage, pure arbitrage, merger arbitrage, and they had examples of all these fund managers. And then I'm like, yeah, all of them were pretty good. Some were great. Some were very, very vague. And then your Forex guy, he came out, he was talking about this, that, and the other thing, and he was talking about carry trades. I'm like, dude, that's a dead trade. What are you talking about, right? Right? What do we got left in the world? Peso and Rand, right? I love the days when you were buying New Zealand. Like, nothing exciting happens in New Zealand. That's why no matter where you go in the world, if you're doing something exciting, you'll run into a couple of Kiwis with backpacks. You're like, what are you doing in Ecuador? We're not in New Zealand, right? So, New Zealand is safe and stable. Dude, I was making 800% a year just on the interest rate payments on the New Zealand dollar. Like, that's a carry trade, right? No risk, high reward. So obviously South Africa as a currency has a little more risk, and that's why it pays a higher interest rate, right? I liked it when it was just the New Zealand economy was so simple and so stable, and the political, the political environment was so simple and so stable that everyone in the country was filthy, stinking rich and had inflation because China would buy everything New Zealand would produce, no matter what the cost was. So that's why they had the good inflation, right? They had lots of money, lots of exports, massive amounts of foreign exchange at their central bank. And because everyone was doing so well, they had to jack up interest rates, right? And you're like, that's the good one. So let's get the Kiwis back to that, huh? You imagine? China's booming, so they're willing to pay $1,000 for a wheel of cheese that New Zealand produces. Right? Bob Dole says sell USDs was right. That's funny because those are both funding currencies hash, so it's a little funny. But so anyways, that's what I'm trying to do. Answers, maybe we'll get there again sometime. I don't think so. Not for a very, very long time. And I mean, like, it could be 30 years. So, I don't know. It won't be the normal way. I mean, Japan's not a great example, but it's a decent example. And Japan has been doing quantitative easing for decades and decades. Zero interest rates, quantitative easing. They're not just buying bonds, they're buying the stock market to the tune of 70% of the whole entire the stock market. While the central bank owns 70% of the stock market, SoftBank owns the rest. So it's not even a real stock market anymore. Okay? And yet, they have no inflation. Yeah. So, when are we going to get New Zealand? Okay, wow, you guys get me on these long things. I don't want to get long on this. Let me do the short answer. Over the next 30 years, or maybe even the next 10 years, quantitative easing will stop working. Ooh, that sounds like clickbait, right? I could do a Facebook ad. Click here to learn more. Yeah, so what we know, how about this? Before quantitative easing, how did the central bank manage the economy? Yeah, right on, Blue Boy. All right, interest rates. Thank you. That's a standard operating procedure, right? The economy has got too much inflation, you raise interest rates. The economy has falling prices, you lower interest rates to stimulate demand. You either stimulate demand or you temper demand. You stimulate enthusiasm or you temper enthusiasm. Great. So now we're at zero. Now what? Now that doesn't work. And who's at zero? Everybody's at zero. Okay? All right. So the interest rate regime or mechanism for central banking policy is dead. Doesn't exist anymore. Okay, so now, right, OECD countries have interest rates at or near zero or even negative interest rates. And that doesn't work, right? Isn't that amazing? Even free money doesn't work. So that's dead. Interest rates are dead. Sorry, Europe, for all your mistakes. All right, so now the next one. Quantitative easing. That works, but that creates income disparity. And people get really mad about this, and they get very, very upset. So please don't get upset with me. Here's what happens. People that have had decent, good professional jobs the last 20 or 30 years, with the job, they get some salary, and they also get a 401k. And the American dream since World War II has been to own your own home. So most Americans, they have an education, get a decent job. The job comes with a retirement account. So you put some money in and save it for 30 years or put it in the stock market and save it for 30, 40 years. And the company matches and puts some money in there and all that kind of stuff. And it grows and you'll have millions of dollars when you retire. Cool. Meanwhile, you're like, oh, you fall in love with someone beautiful. You get you share an apartment for a few years, then you get married, and then you're like, okay, let's have some babies, and you go out and you buy a fixer-upper, 3-bedroom house, 2-bath, and a 1-car garage, and you start a beautiful, wonderful life together. And over the course of time, through the cycles, maybe over the period of your life before you retire, you probably end up owning about 3 houses, and you keep trading up through the real estate cycle. And then now you retire and you got millions of dollars in your 401k. and you flipped your house multiple times, you don't have a mortgage, and you sell that and you move back to the apartment and you made a couple of $1,000,000 on that. So now you got 5 million, you got to live off of that, or whatever the number is. Okay, maybe it's 2, could be 5, whatever your number is. It just depends on where you started with and all that. Okay, so when the Fed comes along and realizes 1% interest rates, or 0.25 interest rates, because they did quantitative easing a long time ago back, right? So back in the time, even 1% interest rates were unheard of. So when that wasn't working, they designed quantitative easing. And that pushes up the value of assets. So, like I said, those that, had a college education, got out and got a career type job, they were, a product manager or something. And they had a career through those types of companies, and they kept rolling over their 401ks as they moved from one company to another. It's been growing. They own a house and that kind of stuff. Quantitative easing kicks in, and it pushes up the value of your stocks. So your entire retirement account goes up and doubles, and the value of your home goes up. So now the income disparity isn't because the government's doing something evil, but for those that didn't have the education and didn't have the career, but instead had a job, and they didn't have a retirement account, and they because of that, they were not able to buy a home. So now they have no money in the stock market, right? And they don't own. So by and large, they just don't own any assets. And so for the last 20 years, the central bank regime of most of OECD countries was to push up asset prices through quantitative easing. And that's where you get the income disparity. Okay? Yes, there's racism and all that kind of stuff going on, and sexism and hatred of all kind. But this was a class issue. Right? And I don't think someone said, we're going to screw over poor people. It was just like, what are we going to do to save this economy? Well, we need to push up asset prices. We need to put money into the system. And so those that just happen to be in that scenario, and you can think of like fairly regular folks, right? Fairly regular average Joes have 401ks, and they did really well through this policy, but the other half of America didn't have it. Now, the interesting thing about America is you can step up whenever you want. Right? That's the wonderful thing about America. You can step up. Yes, it might not be perfect. Yes, it might not be a perfectly level playing field, but you can do it here, for show. Right? Right? And I have friends that are immigrants from like Germany, from India, and a couple other places. I mean, I have friends that immigrated to America from all over the world, but these ones have gone on to become millionaires in the United States of America. They showed up with visas, became citizens, and are now self-made millionaires. I mean, oh my God. Right? And the other ones, by the way, are doing quite fine. So they live in multi-million-dollar houses, but everybody in California lives in multi-million-dollar dog houses. But the cool thing is this is a great country to do it, whatever. So the point was the quantitative easing is eventually not going to work. Because now, if you keep doing it, you're going to create bubbles. And the income disparity is going to be bad. And if you go back thousands of years of study, you end up with civil war. Right? Poor people with pitchforks kick down the doors of rich people and pull them out in the street. So how, right? I mean, you guys could see a situation like that, right? Where the rich are so rich and the poor are so poor that inevitably there will be an uprising. Well, nobody wants that either, right? So what's the next stage once quantitative easing is done? And then I'll move on. I didn't mean to do this conversation. You guys ask good questions. But let's carry this through. So the rich people are already fabulously rich. And the problem right now is the poor are horribly poor. Well, government gets elected to deal with the problem. And the solution is just simply give them money. Now, it's not really a solution for the poor people, because now you get to like a psychological level of slavery or something horrible like that. Maybe slavery is not the right word. It's a touchy word, but you get paid to do nothing. So right? So what it ends is it's a mental where you never want to do anything because there's no incentive, and then you teach your children not to work, and all of a sudden you have a whole subset of society that doesn't know how to work, has been taught not to want to work, and there's like no productivity at all. But it's cool because it just keeps the rich people rich, and they're like, look, as long as these guys don't show up, right? As long as these guys don't show up on my door, as long as I don't have to look at these poor people when I drive to work in my Rolls Royce, if I don't know about them, I don't see them, they don't piss around with all my expensive stuff, then we're cool. So it's like insurance. But as Maida says, welfare mentality is like that in Cuba. Like it's a real thing. Like there's real science behind all of this. But what'll happen is the system will break down. And I think what happens is it actually speeds up the process. Because the amount you give is never enough. And we know this through the study of management. So my degree is in management, right? My master's degree is in management. And there's lots of studies that you pay someone more and then it's not enough. And they'll want more and then it's not enough. And it's not enough. It's never enough. There's never enough. And so if you pay someone $100 to do nothing, pretty soon it's gonna have to be $200 because why, right? It'll be more, and they're like, well, if you don't pay me the $200, quote unquote, I will destroy you, right? Okay, well now you have to pay them $200, and why not $500? So like my solution was to create a society and support this society, right? Create a society of entrepreneurialism. The only way out, I think, is to allow people to express themselves creatively in such a way that it also is productive and they can earn an income and do really whatever they want. I think the 9-to-5 job is dead. I haven't worked 9 to 5 ever, I don't think. So all of that, right? All of that is dead, but create, but also support entrepreneurialism. Right? If you got nothing to do, if your wife is watching Dancing with the Stars and you can't take it anymore, you're like, you know what? I'm going to go out for a couple hours and do some Uber drives. And you go out for a couple hours and you make whatever Uber drivers make. You do 2 or 3 runs and you put some money in your pocket and you're good, right? Okay. So anyways. So that's so by the way, to create and support a society of entrepreneurialism, that ain't going to happen. So what will happen is the division will probably get worse, not better. I'm sorry. And I don't think it'll be Biden, but let's say 12 years from now, we still have the Democrats in power. And because the social division will get worse. I know that because this is the policy we're on. So the divide will get worse. There'll be more riots in the street and all that kind of stuff that's been going on in America. And we will get to the point where we will simply bribe. Stop rioting. We'll just give you free money. And it's over. Okay, it's over. I don't mean that from a political point of view. I mean, some of it is, but it's more of it's a short-term failed policy of like make the problem go away instead of dealing with the problem. Okay. All right. So let me go back to this. This is weekly now. I'm not looking at what's happening today, tomorrow, yesterday. If you were looking at a 15-minute chart, do you think it's pretty reasonable to expect this? Talk to me, Goose. Yeah, Pat says, yeah, yeah, Pat, I mean, yeah, changes need to be made for sure. You know what's crazy is the thought of how China is becoming more of the old America. I don't know how many of you guys have been to China, but it was horribly poor, and then all of a sudden it's fabulously wealthy. So the United States, let's say before 1900, was pretty modest. And then after World War II was a superpower. I mean, dude, in less than 50 years, went from not even a player to a superpower, given the reserve currency and all this kind of stuff, like zero to hero. Pretty quickly, right? And part of that had to do with the war and all of Europe flattened after 2 world wars, right? So America was, okay, the only superpower left. Now, China has become fabulously wealthy, better infrastructure, better buildings, better almost everything. Sorry, America. And it's maturing quite quickly, right? But I think the real thing is when you meet entrepreneurs from China, they're like, we're Chinese, we are going to take over the world, we are better, we're stronger, we're smarter, right? We have more education, we're more entrepreneurial, and they put it together and they get stuff done. But that used to be the American gung-ho, anything can be done, let's just work together and America will fix things. I'm not sure we have that anymore, and I hope we do. But like the American gung-ho, together we can fix anything, that's much more like the Chinese right now. And the funny thing is, I have one game on my phone, right? And I play every day, and I've been playing every day for probably 12 years. the one game. And it's one of these war games, because I like strategy. And very often, you come across, you attack another village or whatever, and it's run by someone from China, because they've moved all the trees around or something, and it says China #1. But like America #1, right? That's how it used to be, right? I'm not going to tell you. But there's this attitude now out of China, like sort of the catch-up attitude. Like they're really psychologically want to challenge America. And so I hope America still has that, like, if we work together, we can do anything. That's the attitude I'm talking about, right? But right now, China's kind of like that. Right? So we'll see. And if that changes, if America becomes defeatist, like more separated, right? Right? Then, ooh, that's the problem. It's the separation that's the problem. All right? There'll always be income disparity. That's part of capitalism, right? I mean, what does capitalism do? You give a bunch of old white men with gray hair power, and then they're like, we're going to go to war and kick your ass because we're #1. And then you send a bunch of poor people out to shoot people, right? You're like, whoa. But that's been going on forever. But if we can fix the divide, and the divide's been in America for a very long time, but that's a big, long game. So my point, let's go back to this. Maybe, just maybe, there's still some up. And I think today is going to be key on like this euro yen, for example. Okay. So should I care about $1.24? Ill yeah. That would be most ideal. I don't want to do a full trip down to 22. So I can leave markers to remind myself. $22, $23, $24. Disparity. Well, disparity made us as disparity is a human sin, not capitalism or socialism. Social think. I mean, they're just economic systems. Socialism makes everybody equally poor. It's never, ever made everyone equally rich. It will never do it. It doesn't function that way. Everyone will be the same and it won't be rich. Okay? And then since you won't be richer than your neighbor, then you will just all be sort of this similarly miserable. So now the next thing is capitalism, by design, gives more to some than less, and less to others. Because it says, well, if you want more, be productive, and the more productivity you produce. So like I tell my kids, not only do you have to be smart enough to solve problems for people, because people will pay you money to solve their problems. I said, the bigger the problem you solve, not the more complex, just the more valuable problem you solve, the more money they'll pay you. Okay? So you can be smart enough to fix a bridge and you'll make a couple $100,000 a year, but you could also be smart enough to fix an algorithm at a hedge fund and they'll pay you $2 million a year. Why? Because they manage billions of dollars and they're like, we need this fixed and we need it fixed quick. Okay. Right? It's not that it was more difficult. It was just you were dealing with a bigger problem. So capitalism does divide. That's what it is. It's just like, but if capitalism doesn't care who you are or who you worship, what you look like, all that kind of stuff. It's just like, be productive. It will produce income. Your income, you will spend, which is someone else's income. But the bigger the problems you solve, the more income you're going to earn. Because you're solving things. Now, you might be solving things like a company needs someone to stand at the cash register, put clothes in a bag, put a receipt in the bag, and then say, oops, I was supposed to upsell you some socks, right? That's not a big problem. It doesn't earn a lot of money. If you can do brain surgery, because people in our country from time to time require brain surgery. They're like, oh, can you fix this problem? I need my brain operated. And they're like, well, it's going to cost you $300,000. You're like, okay, let's do it. Different problem, right? So anyways, to me, it's being productive and then what are you being productive on, right? No, I know I know what you're saying, man. In fact, I took a whole class from a woman that worked at the New York Fed, the New York Federal Reserve. And it became a debate. Actually, I mean, it was about debate. So I've actually debated the minimum wage. I've seen the stats going back decades that she brought from the Fed with her, and I'm telling you, it was one of the best memories I have of Harvard, because in one of the classes we did research on what normal people are like. I'm not kidding. It was such an amazing moment. We watched a 2-hour video, in fact, about what people are like. I'm not kidding. And I even told her, I said after, I'm like, there's a lot of humor in that. And she's like, what do you mean? Well, you showed it, we've been studying what it's like to be a single mom, trying to raise a kid. You don't have a great job. You work in a nursing home. You do all right, but things are stretched. and you got to apply for certain government programs to earn some money, and you really rely on your minimum wage and all that kind of stuff. I mean, but that's like 90% of America. And I'm like, that's funny. Like, you're teaching us Harvard people what normal people are like. And I'm like, it's super funny. Don't you see it? She's like, no. All right, fine. So, yeah. Yeah. Thank you, Maida. Okay. So this is where we are now. You should know in the process. I mean, not a lot has changed. In fact, when I woke up this morning, I had the same amount of money in floating profit and loss this morning as it did last night. So I'm like, oh, nothing happened. Of course, I didn't see the up and down, but I look at it, I'm like, huh, nothing really happened. Okay. So nothing's happened, so you should know all these things already. But we're more interested in, like, what about the rest of the week? What about the rest of the month? And those are the bigger questions, right? So here we are. We know the obvious, simple, boring, textbook, straight out of the trading course trade for a bull is buy this, exit there. Now, bears would have sold here, and I think they did. And their target was here. And I've always told you, you never know which one is right, so you need to have a bias. There's nothing on the chart that will override probability. You just have to bet on the horse you believe in. And by the way, this is one of the things in the hedge fund research that we're doing. The more you focus, the more you believe in the horse because you've researched the horse, the more likely when you bet on the horse it's going to win. Conviction, it's called. And then concentration is the next thing, right? You're an expert in 3 horses, and you know if they're going to win, lose, or draw every single time because no one's smarter than you about these 3 horses, right? So you only bet on the races with those 3 horses in it, or one of the 3 horses in it, and you do very, very, very well over small periods of time, but you're only betting when you're certain of winning, and you're shocked when you're not. So at the end of it, you have low volatility, and you have quite good returns because you only bet when you're absolutely certain you're going to win. Well, this is what we do too, right? So if you were a bear, you have 100% conviction. You're like, well, it was bearish here and it was bearish here, so you're going to sell here. That's exactly the right thing. Well, you say, well, Wayne, it didn't make any money. That's not the point. Chasing candles is like chasing ghosts. They used to be. So if your trade plan was this, perfect. You did an amazing job. You're like, well, it didn't make any money. So you had a shot. You took the shot. I don't think you lost money. And now bulls, look. Okay? Now, the funny thing is, you're like, well, Wayne, there's nothing bullish here. Well, I told you, I'll just make up a number, 34 weeks ago that I would be this week. Lucky son of a gun. Okay? And it climbed up beautifully. There's the first entry. There's the second entry. And now in a normal week, this would be the target. Cool. So you know all that. So everything after this is either a counter trend or second chance, next wave, all that kind of stuff, right? So now this is why I'm saying we should be, why I'm testing, because what I think is that we override all our normal rules of engagement and we do something like this. But I don't know that. I think that, but I don't know that. So to change the perspective for those that are newer, that may be missing some of the point here, normally, any other given week, any other given month, I would sell up in here and target at least this minimum, but probably many times get this. It's either going to be a reverse, a very deep pullback / reversal or complete full bore market reversal. Like full bore, full stop. Okay? But I'm saying in this moment, in this circumstance, for variables unseen on this chart, I'm thinking not this time. This time, there's no pullback. This time, there's no reversal. This time, we buy the dip and break through and have a massive week. But I think it's going to be slow as molasses on a cold Georgia morning. Okay? On says also on USD pairs, they're going to be more volatile. What are the two components we were talking about before the election that would really, really weaken the USD? Can anyone contribute to that? What were the two things we talked about in regards to USD that would weaken them in the short run? Certainty about the election and the stimulus package. We got one of them, and that's why we did very well. This is CAD yen. This is not even a good one. CAD yen didn't even perform well. But like the dollar pairs, okay? Now what? Well, okay, this is supposed to be falling. See, that's why it's bad. Because we, quote unquote, cured COVID. I know. It's not really a cure, but whatever. Now that we're past the worst, we're through the trough, we're not going to get a stimulus. Meta says they'll need to wait till January. I don't think there's a possibility that they don't do anything. They're like, we're going to spend the money on rolling out vaccines. Like, there's no need to spend $1 trillion. We're through this. So that's the issue now. You're like, people bet on the stimulus. You have to understand that. 500 billion? Okay, but, maybe not. Okay. Okay. Yeah, I don't follow it that closely, so thank you, Meta. 500B. All right, well, that's not 1.6 trillion. So that money, see, like this move, for example, not this one in particular. I mean, maybe not. But when looking at the dollar, and we talked about stimulus, that would weaken the dollar. Okay? So part of this move here on this pair has to do with stimulus. Above 1T, I think, right? Like minimum. Right? Which means they're it was oversold is the other way of looking at it. It was fundamentally oversold, not priced, not technically oversold, fundamentally oversold. And there has to be a regression. People are like, oh, snap, what about my 1.6 trillion? Oh, sorry. Well, how much then? 1 trillion? No, sorry. 800B? No. How much? 500B? You're like, oh. You have to understand, that's at least $1 trillion short of what was priced in. So again, I don't think this is people buying the USD. I think this is people getting out of selling. They're no longer selling the USD. It's similar but different. Okay? Cool. So one of the ones here, okay, this is the end of the peso trade. This is the projected short, the projected low for the month of November. Isn't that nice? I hope you're starting to truly believe in pivot points. Let me say that differently. We knew that was the projected low before the election. Crypto is on USD Swiss franc. Someone else also, like Bob Dole. Bob Dole likes USD Swiss franc. Someone else said that earlier, so I guess we'll have to look at it. Yeah, no. Yeah, I have no problem looking at a Swissy for you guys. I probably just don't even have a chart for it. There we go. I do have a chart for it. Yeah. All right. So, if you were a bear on this, so remember, in November, I was bearish USD. Okay? So, there's no, like Swiss franc I would have been bearish on too, but it's been decoupled for a while and I don't care, and that's why I don't want to even look at it. But can you guys confirm that you knew? Well, I guess you wouldn't have known because I would have been, so that's why I don't trade it. All right, I'm talking to myself in circles. It's very circular, this argument. Okay? All right. So anyways, I'm bearish on US dollar. You know that. Okay. So I would be trading it on a chart that looks like this. Can you see it? Position trading, bearish bias. Okay. Now I need to update this and say I need to know where to get out. That's what that says. There's the conservative target and the aggressive target. So on the very first day or days of the month, I want to sell around here. And I'm targeting somewhere between these prices for an exit. That's it. So this is an example of the stop and reverse I was talking about, where I'm trying to analyze whether the yen pairs are going to do this. And the dollar pairs. And I would never analyze it with this pair because historically, maybe not this year for whatever reasons, historically, if dollar's weak, Swissy's weak. Okay? But Switzerland's largest trading partner is Europe. And so they're affected by the euro. So here's what normally happens. Euro dollar is 40% of the entire foreign exchange market. Okay? Okay. So if the reserve currency has a weakness regime, dollar weakness regime, then by simple definition, when the central bank of the reserve currency decides to depreciate or has a policy that ends up depreciating the US dollar, then this will have to go up. Sorry, this is euro. Sorry. Okay? Because the Fed's bigger than the ECB. You see? Salado Club says, Wayne, why is that you do not lens much on monthly pivots on or before going to... No. Everything starts with monthly pivots. So I'm not sure what you're saying, Salado Club. So anyways, going back to this, if the Fed says we're going to weaken the dollar, euro goes up irregardless of what the ECB is trying to do. And very often, the ECB is trying to make the euro go down, but because of the Fed, the Fed pushes it up. Okay? Which should weaken Swiss franc. So that's where I get caught in this idea of if dollar falls, that affects euro. And if that affects euro, that affects Swiss franc. And if that affects Swiss franc, no, it's not quite circular because the Fed doesn't give a damn about the Swiss National Bank. But anyways, there's some sort of relationship. So that's why I'm like, well, this might not make sense to be trading. And I see the analysis there. But because of that, that's probably why you get the full 100% retracement. And I would not like that. So if you were going to trade it, you have to be getting in and out at exactly the right price. And that's complicated too. Okay. So now contrast that with this pair, Aussie versus Swissy. At the same time, you can just say, well, right, you're a bear on the Swissy, which I am. That's why I can't trade Aussie Swissy, because I'm also a bear on the US dollar. How many people know that? How many people know that? I'm bearish on the Swiss franc and I'm bearish on the US dollar. Now, I've been wrong a lot this year on Swiss franc, but it doesn't matter because I haven't been trading it because I haven't been right. But how many people know, like right off the bat, I'm a bear on the Swiss franc, so that's that. Okay? I haven't had, I could have had I wish I had a lot more Swiss franc short trades, but it just didn't work out that way for me this year. Okay, fine. Doesn't matter. But you know, the only way I would look at this trade is this is a plausible buy. There's no sell. That's why I have bias pivots. Okay? So we do something like this now, where I go template, again, position trading bullish. I only look at it as a bull because I'm a bull. Okay? And now I gotta update this and change this and put the conservative target, not just the aggressive target. And this is how the Wayne do. This is how the Wayne do. I have to make a decision on the last day of the month or near the last day of the month. Do I buy or do I not buy? That's the way of the sword. That's how the Wayne do. Narcissist, right? They should rename it Biden Care. Okay, so, and here's the target. And you'll say, well, so what, Wayne? It's not a lot of pips. A lot of other things did this too. Well, I'm contrasting Aussie Swissy versus USD Swissy. USD did this. And that volatility can be bad for you. Okay? What we're trying to do is catch a trend, and trends don't do this. Trends do this. Copacabana. Well, you're either a bull or a bear, or you're a pig. That's how it goes. Copa. So I'd take the Aussie Swissy over the USD Swissy every single time. And that's why I do, that's how the Wayne do, right? Cool. This did not go at all like I was planning today. It's hard to break old habits. You guys are inquisitive. Okay, so I almost made a mistake here, and I almost made a mistake here. So thank you, rules of engagement. A couple of days ago, I almost shorted both of these. I think just the 4-hour 21. I can't remember if it was before that or after that. I can't remember, but I remember I almost did. But I've had to temper my enthusiasm, and that makes sense to me. So whatever. So now what? Now what do we do? What do we do? Well, you can look at this from a swing trading point of view. I can only be a bear. So I have this. What do you see? Talk to me, Goose. How do I trade this? Thank you, Luthando. But here says Swiss has been out of swing. Yeah, I haven't been getting what I've been hoping for. That's all. New trader says up, 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 sell. Well, we already have up, up. So what this is showing me is based on what I expect next week. Not today, not Wednesday, not Thursday, not Friday. Okay? But between right this second and Sunday 6 p.m. or Sunday 5 p.m. Okay? I want to sell this. It could be right this second. That's pretty aggressive. So now I'm done, right? You understand? This is next week's trade. Doesn't mean I have to wait till next week. But if I pull the trigger short, it's not because what I see now. I'm not saying like, oh, well, look at this candle here or something. Like, no. It doesn't exist. What I'm going to trade doesn't exist right now. But by the time it's reality, I created reality. I'm the boss. Remember? Narcissist. Okay. Right? Morena keeps me humble, though. She keeps me in check. So what I'm thinking is somewhere in here, I need to get short. And I need to be on smaller time frames, and I need to wait. And I need to ambush. Okay. Well, you can define market as bearish, which is true. There's multiple ways of defining that. But to say it, the same way, but only differently, Luthando, is I'm a bear. So, it's going up. Yeah, so what? Waiting for the 55 EMA? Not really. See, the EMA's lag, so I have to shoot in front of the 55. By the time it hits the 55, it'll already be down here, right? So I'm eyeballing that. Then I look for psych levels. Well, 16's way up here, so that ain't going to be it. So it's a bit of price action. It's a bit of Fibonacci. All of it is correct. You have to understand there's no wrong information unless you draw your study incorrectly. And you might watch me draw my fibs right there and say, wow, you did that study incorrectly. That's how the Wayne do. But that's what I'm thinking right now. This can change. And if it goes higher, it will change slightly, but probably not significantly. So if I don't get an entry and it continues to go up, that's all right. The analysis adjusts. Okay? And plan B would be more like this, I would guess. But right now, it's a guess because that doesn't exist. Okay? So I'm making plans now. I say I'm making plans now based on things that don't exist. Well, they don't exist in reality at the moment, but in estimation. You can estimate, for example. And the estimation says I should be short 15.69995 about. We'll just call it, how about 15.7? Okay? But if it continues going up, the statistics change. Remember, it's statistical analysis that I'm doing, not technical analysis. So in that case, if it goes up, I'll probably have to adjust, and it won't be 15.7. It'll only be 15.7 if it starts falling now or very soon. At least it has to stop making a higher high, which means moving averages need to cross over, oscillators like a Stokes needs to cross over, and all these wonderful, cool things that we use. I can anticipate it all now. Doesn't mean it'll happen, but if it does happen, all those things will also happen because that's what those things do. So right now, those things won't help me make the decision. Those things will put me in because I've already made the decision. Okay? So if it does go up, I have to adjust my statistical analysis, and not just because it's 50%. More like it's 50%, and this was this week's sell zone. Now, we didn't get a sell because the week before, so that's why I've shied away. I never really got an entry this week, and last week I was too busy loading the boat on dollar pairs and yen pairs, so whatever. Never got to it. So now I want to get to it, but I got to wait my turn. So now, if it continues to go up, I want to have a turn, but I could have a 50%. But also, what's the definition of a downtrend? Well, this week, or let's say next week, has to be lower than this week. If it's higher, then the market conditions are not favorable for me to make easy money. Okay? So, in my mind, statistically speaking, in current market conditions, right here, right now, I would be looking to sell. Not based on what happened today or yesterday, not even based on what might happen tomorrow, but basically next week. And then, what's happened this month, I've analyzed that, and by a month I mean essentially next week, this week, last week, and the week before, so trailing 4 weeks, there's a 50% regression, which we know if it is a regression, 50%. What's the other word for 50%? What word do we use when discussing regressions? A regression to what? To the mean. Yes. And what's another word for mean? It's not median. It's not mode. But what is mean? Average. Thank you. And 50% is pretty average, halfway through the data set. So in a sense, I'm doing the math here to say I don't mind the regression, but I can't have a higher high. Okay? It doesn't mean it's an uptrend, but it takes me out of the game pretty quickly where I'm like, not interested yet, because then I will need this to top out somewhere and then make a lower high and lower low. So it could take me 3 weeks to get back in. So I'm not planning on that. I'm just saying if we're up here, I'm not interested. It could take 3 weeks to a month to get back in. So I boil it down to, like, I know what I can't do, which is part of planning, right? I won't do this, I won't do that. So how will I behave? Well, it's not likely, but it could happen in the next day, or let's say later today, or in Asia tomorrow. I might get something on a smaller time frame that gives me permission to kick it off this 15.7. And if so, I'm like, that's my 382. That's a nice little retracement where, that's next week's M3. And I start putting together things like, okay, next week's M3, I got a 382. This is probably a daily 21 up here, or near. We're probably right now at a daily 8. So I'm like, okay, so I got the day behind me. And of course I got the fundamentals and I got all that kind of stuff. So boom! The next 12 hours I get short. If that don't work none, it's all right. And I will wait to ambush up there. So either I probably won't get a trade here, but I might. And it probably will do that, and I will. And if it's up here, I'm out. I walk. Not interested in playing that game. Neato, right? And by the way, we can look at this daily and watch. See? Let's kick off the 8. The daily 8, baby. The daily 8. Okay. And I look at the daily 8 somewhat like a non-lagging 21. Why do I do it? Why? Oh, I see what you're saying. And then would you say one standard deviation? No, but don't get carried out with more. Is it one standard deviation, 2 standard deviations? I know there's a guy that's out there, a guru, that uses like two Bollinger Bands. Oh, it's 3 standard deviations. But one of the things, standard deviation is funny because you got to be careful. Because again, it's just statistics. It's not anything more than that. And I kid you not, I was given I think it was a trading simulation. I had to trade bond market spreads. And they showed me a random chart of bond yields. And you know what? I recognize them. So they're like, trade this, trade this, trade this. And so I made my trades, and I lost money, but the whole point, it was designed for me to lose money. And I think the way it was designed was most people would blow up the $1 billion account. And I didn't blow up the $1 billion account because, first of all, I understand leverage. We're traders, right? So most people are over leveraged. So they're like, oh, it's only 100 million. Oh, dude, seriously. So while other people were probably trading 10, 20, 30, 40 million at a time, I was trading 1 million. So I lost money, but I think I lost the least amount of money most likely. But the funny thing is, they gave me these random charts, and I recognized the charts. And I'm like, I know what this is. This is LTCM. This is Black Scholes. Oh my God. So then it said, what did you learn from this simulation, this trading simulation? I'm like, first of all, I have no information to go by. There's no logic. There's no strategy here. You're just throwing out bond yields and asking me to place bets. That is a failure in of itself. This is my answer. But here's the second thing. I'm like, I think your point is, leverage is a double-edged sword, and very often you're on the wrong side of it, right? But then I talk about, I think this is Black-Scholes. I think this is LTCM. I think this is the Russian default. And so I literally say it in my answer, like, right, that I think this is part of Black-Scholes and Bill Sharp, and they get together and they after winning their Nobel prizes in economics, they start a hedge fund and they start looking at the regression of yields, on options and bonds and all this kind of stuff, and their own reliance on the model instead of reality made them bet on the model and then of course lose all their bets. And what my point here is, when, let's say, bond yields, the spread between bonds and options, different bonds and different options and all that kind of stuff, typically isn't much. So like yesterday we talked about a fresh cut 10-year T-note and a 3-month-old 10-year T-note. There's not much different, right? So the difference in price or yield would be minimal. So I think I said this one would be 6.008%. And of course, this is a fresh cut and it's 6.0%. So there's very little difference, right? But then what happened after the Russians defaulted, instead of like the difference being 0.008, let's say, percent in yield, we're talking yield now, which is another way of looking at price. But let's use the yield because that's what Black-Scholes was about. What if suddenly this went to 28, 0.28, not 0.008? And what if you had a model and you went back and you looked at 1,000 years of trading and you found out within 3 months, it would be back to 0.008. What would you do? That's your hypotheses. So you can buy one and sell the other, or just say, there's going to be a return from 0.28 all the way back to 0.08. And that's what they did. Okay? That is a regression like we just talked about. You expected a regression. They bet the whole farm over and over and over again. They kept putting more money down on losing trades and losing trades. They're losing money because this actually went to like 4.8. And they kept putting more short. It's going to go down. And it kept going up and up and up. And then it would go down a little bit and they're like, aha! And then it would go up again. Classic amateur moves. Okay? And they blew it up. So, be careful what you do. Don't go around breaking young girls' hearts. My mama always told me, be careful who you love. Be careful what you do before the lies become the truth. Oh, wait, that's Michael Jackson. Oh, sorry. No, so be careful about making decisions because of the oscillators, because of the moving averages, because of the pivot points, because of the linear regression. You need to make the decision first and foremost. And if you're wrong, take a small loss. And if you're right, get paid, let it run. No, Lira, Donald, is out, but Rand is in. Trader how many people recognized what I was saying, but you couldn't quite pinpoint it, or did anyone know exactly what I was getting into? Anyone's like, wait. And Jesus, I am the one. Yeah. Boom, 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 boom. But that's how Bon Jovi starts, right? Instead of going, who, Bon Jovi says, What's that one? Because it starts out similar. Bum, 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 and then it goes. Bum, da, 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 da. Something you paint you paint you did you put me through hell. Saint of love gonna hold on me. Yeah, something like that. Yeah. Whoa, you're alone again. Yeah, something like that. Cool. So that's my thought process. Did I just put you into a trade? No. But I appreciate that you appreciate the intellectual discussion of the thought process. When, why, how, plan A, plan B, and then walk away. Oh, crypto got it right? But I don't know. Maybe you'll remember I'm funny, or maybe you'll remember the lesson. I don't know. But if you don't remember it, it never happened. That's why I keep asking you guys. Because the more I ask you, like, how many people remember this? How many remember that? Like, if now you remember a conversation we had 9 months ago, it's amazing if you think about it. Think about how much you remember that particular day besides that one thing you remember with you and me. So you and me, my voice and your ears had a conversation. And your thought process, because we had the conversation and then I did something so you could remember it. But what else do you remember from that day? Unless your dog died, probably nothing. Boom, 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 boom. Okay. So I almost shorted this. And I didn't. Almost did. I almost shorted this. Not today or maybe in here a couple of days ago. I think this would have been it. This is what I would have done if I was me. I would have sold this. I was preparing to, off the 21, off this zone. And I backed off. I'm not entirely sure why. So let's go to Confluence. Oh, yeah. Well, there you go. Done. Can't short that. So too little, too late. So I didn't do it, and thank goodness. Michael, that's funny. So you remember my story about NLP and the tree in Paris. That is so funny. So when my son was 10? When my son was 10, I took him to MIT because he's an engineering mind. He's in gifted math, and he's in a grade or two ahead of the other kids. So he's in gifted math, and he's gifted, right? So my son's good at math and a few other things. So when he was 10, right, when he's just getting an identity of self, of who he is and where he fits into the world, I took him to MIT, right, Massachusetts Institute of Technology, the best engineering school in the entire world. And one of the things I did is I took him on campus, and we looked around, we played, and we had fun, and all that kind of stuff. But I took him out sort of to the old building. If you go behind the old sort of science building, I think it is, right next to the Harvard Bridge, inside that there's these rows of trees, just like the ones the Eiffel Tower in Paris. And I walked him over there and we had a conversation about, you know, the meaning of life and the future and his destiny. And then I had him touch the tree. I said, you'll always remember these trees. And if you come here 20 years from now, this tree will still be here. Like, you can touch this tree, and I want you to remember this tree. So if you decide you want to do this, if you decide you want to come to MIT, and you're willing to put work and sacrifice and effort to get here, I want you to come back to this tree, and I want you to touch it. And I want you to remember that you did this. This was you. You decided, and you made it happen, right? And so we touched the tree, and we're talking, right? And it's a moment that's remembered. So one of my many theories of life is that it's only the things you remember. And of course, you don't remember 98% of your life experience. So you have to train yourself to have moments in time that you actually remember. And you have to create those moments. Yeah, I think so too, Michael. Okay. Bitty, 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 can't you see? It's been going nice. Up, right? Up, over, by. Up, over, by. Up, over, by. It's really complicated stuff. KG has a very weird memory. Well, the human brain is so smart that it will change memories as a coping mechanism. So when I was in college in the 90s, I was interested in being a lawyer. And so I explored that. I took a lot of law classes. Even back then, I was in graduate classes. I went to family courts, and I would watch. I'd literally sit in court and take notes. And I had an internship at the district attorney's. Right? And so in one of the administration of justice classes, we did a lot of psychology. And one of the most inaccurate pieces of data is eyewitnesses. Someone can watch the car accident from the street. Bang! Saw the whole thing happen. Very, very, very inaccurate. They were there at the moment. They watched the whole thing. But you have 5 people from various points, theory of relativity, right? From various points around the car accident. They all saw it. They all saw something different. It's amazing, right? And so that's our own memories are very, very, very inaccurate. So you have to really choose what you want to remember and why. And that's why you have to be tactile and visual, emotional, intellectual. You have to set the whole thing up. So long after I'm gone, maybe, just maybe, my son tells a story to his children about the time I took him to MIT. And maybe it changed his life. Maybe it didn't. But maybe it did, and it was memorable, and therefore, you know? All right. So anyways, okay, let's go back. Someone asked, about moving averages and stuff. Okay. This is the... Okay. So at this cross, so if you read my book, this defines a change in market. And this is congruency with price. So this is market. At that moment, you are a bull. Okay? And at this moment, you buy. and somewhere in here you buy, and somewhere in here you buy. And you're kicking it off the 21. Okay. And the interesting thing is, just using standard operating procedure from 2 decades ago, there's not even an opportunity to consider selling. Can you see that? And isn't that part of the value, that you know not to do at least one of the two things you could do? There's no opportunity anywhere on this chart for selling. So there's only choices for buying. And this is classic. Okay? This is all classic. Just using the moving averages. Now, if you drop into pivot points, you're like, well, you were supposed to buy here. Okay? This is OOP. You're supposed to do this. Everyone that has done through the course, has gone through the swing trading course, they're like, oh, that's so obvious. At the exact time, too. Like, it's so obvious. And then you're like, oh, OOP. Okay? And then here, there's, again, the obvious entry. Okay? Again, obvious entry. Whether it's here or here, it doesn't matter. It doesn't even matter. But if you're polluting your brain with variables that don't exist, then you're not likely to make the right decision. Okay. Michael says 21.55, 200, found out. Yeah, but I don't even care about the 200. I don't care about the 200 until we double top, hit 55, lower high, and then at that point, I'm like, we're going to the future 200. Okay? Remember, the 200 is a target. Well, I'm getting used to my coffee. So my coffee now has 21% of my daily fat. Is that right? No, it's more than that. 21 grams of fat. Yeah, I think that's what it is. 21 grams of fat in my coffee, which I think it's like 70% of my daily intake of fat. So every once in a while, it's cold now. I'm like, oh. Okay, now. So I don't know how long we've been talking, but it feels like it's reasonably enough. Oh, 2 hours. Yeah. All right, that's pretty reasonable. So would you please click the like button, please? That way, I guess, according to that guy that was screaming and yelling at me today, if you click the like button, it will make me rich. What? Boy, you don't know YouTube if you think that's how that works. I'm asking you guys to click like because I'm hoping YouTube says people that watch these videos think it's quality content. Maybe we should promote it. And I'm hoping we can have a positive impact on people's lives. Some of you I've known for 15 years or more. Some of you are here for your first time. There is approximately 6,000 videos attributed to my work on YouTube. 6,000. I'm just trying to make a positive difference in the world. Okay? YouTube has paid me enough money to buy wine. Over 14 years of doing videos on YouTube. Yeah. Right? So I don't ask you to click like to make money because it doesn't make money. It's not whatever. I'm trying to make a world a better place. I paid my dues. In the beginning, I did it because I was angry that it was such a secret and it just pissed me off. And trading alone, and back then, I was completely alone. There were no other Forex traders. I was completely alone. And it almost ruined my career, my trading career. I almost had to go back to be a stupid venture capitalist or something. But being an entrepreneur, I just never give up. Even if the ship's sinking, there's still a way. So anyways, I never gave up. But the isolation was horrible. So I'm sort of bribing you to hang out with me by sharing everything I know. Good, bad, and ugly. So I hope it helps. I hope this community, I hope we come together every single day at Forex.Today or Traders Way or FX Bootcamp or various other derivatives of what's going on here. I hope we make the world a slightly better place. That's all. So if you click like, maybe YouTube will promote the video in their recommended viewing. And maybe 20 other people see today's video, and maybe one of them says, oh, snap. This is interesting. Oh, thank you, Maida. 2 p.m. Tomorrow's webinar is at 2 p.m. Yeah, thanks, Maida. Cool. Yeah, does that sound all right? Yeah, I'm not killing it, Brendan. Killing it. Yeah, I think YouTube, you would have to have 20,000 views to make $2. I think would be about right. So, just so you know, maybe not. You might need more, but you might need 20,000 views to make $2. Thank you, Grumpy Cat. What I like is someone from 10 years ago remembers the story. So anyways, I got to jump, babe. It was real. Thank you for your positive energy and your support and confidence that we share with each other. That's the point of this community. Yes, we have some laughs. Yes, there's some intellectual discussions. Yes, sometimes we talk about trades or do trades or, all that kind of, it's all kind of mixed. But ultimately, in a time when the world is crazy, where people have had losses, where people have had duress, and we're stressed out from being locked up like an animal, but we can come here and have and share positive, creative energy when, in many cases, people are stuck in misery and anger and wallow and melancholy. So I thank you for being part of something really good. And I can't stress enough, you bring me a lot of energy that I carry throughout the entire day. In fact, my wife asked me why I did something the other day. I had worked all day, cooked the kids' lunch, did the routine, all that kind of stuff. And then I'm like, you know what? I'm exhausted. I'm just exhausted. So I sat in the movie theater and I drank I think a big bottle of beer, like the big ones, right? Not a 40, but big can of beer. And then I'm like, oh, there's a wine out. I had a quarter bottle of wine left. Oh, I'll finish that off. And now I'm tired and I've watched something in the movie theater for like an hour and a half or something. I've had all this alcohol. And then I come back upstairs and I tuck the kids in. I'm putting to bed. I put my pajamas on. And I sat on the side of the bed and the wife looks up from the Kindle and she's like, what are you doing? I'm going to get up. She's like, you got your pajamas on. I'm like, I know. I'm tired. But I got things I need to do for tomorrow. And I got back up and I said, honey, I hope you're not disappointed with me. I'm just trying to do what's right. And so anyway, so I got back up And I put my clothes back on and I put a sweater on and I went all the way downstairs. And a few minutes later, I'm outside with a coffee, a cigar, my laptop, my 3 screens. I got my charts up, and it's midnight. After basically 3 beers and a glass of wine, I got my ass out of bed and went out and did what needs to get done. You're a big part of that strength. You're important. I care. And it's hard sometimes, but I care. So thank you. Peace on earth. May the pips be with you. May your profits be above average. See you tomorrow, guys. Cheers.